What's going on, guys? MMuniz here. Welcome back to the channel. In today's video, we're going to talk about Vanguard ETFs. More specifically, we're going to cover the top 5 ETFs for long-term growth. Now, you may be wondering, why Vanguard? Well, Vanguard is very well known for offering low-cost, diversified investment options, and its exchange-traded funds are no exception to this rule. The 5 exchange-traded funds that we're talking about are simple and cost-effective ways to invest in a broad range of stocks, making them an excellent choice for long-term growth. Now, if you work hard for your money and you want to make it go further, make sure you smash the like button down below, subscribe to the channel. We try to do weekly content on anything related to personal finance or fitness. Now, with that being said, let's get right into those 5 options. Now, kicking off our list at number 5 is actually a choice of 2 ETFs, depending on what you prefer. So we have VTI, which is the Vanguard Total Stock Market ETF, or the Vanguard Total World ETF, VT. Now, these ETFs are a one-size-fits-all of investing. It gives you exposure to the entire US stock market, or if you're talking about VT, it's going to be the entire global stock market. Now, this is going to include large cap, mid cap, small cap stocks. With these ETFs, you're essentially betting on the growth of the entire American economy or the entire world. So let's break it down by ETF. We're going to start with VT, the total world stock market. So VT's investment objective is to track the performance of the FTSE Global All Cap Index, and that represents the global stock market, including stocks from both developed and emerging market economies. The expense ratio is pretty fair. It's only 0.07%, which makes it a cost-effective option for investors that are seeking exposure to the entire world. Not everybody's looking for that. A lot of people will tell you, well, I just want America. That's fine. That's fine. That's why we have 2 options here. But when we talk about assets under management, as of May 2023, VT has around $27 billion in assets under management, and they have over 9,500 holdings. A lot of companies. It does not get any more diversified than VT. You really can't. It is a massive mix of stocks from the United States, Europe, Asia, emerging markets, all over the place. This diversification is going to help reduce risk, while still giving you the potential to grow in the long term. When it comes to top holdings, you're going to see this among a lot of the ETFs we talk about, and we're looking at Apple, Microsoft, Amazon, and Nvidia. These are the big dogs. Now, when it comes to risk, when you're holding the entire world, you're going to deal with everything that comes along with that. So you will be subject to fluctuations due to market conditions, currency risk, and geopolitical events, like the war on Ukraine. However, at the end of the day, the broad diversification across the entire world is also going to help mitigate those risks. Honestly, I'd say it's a pretty low risk investment. So that was VT, but now we got to talk about the brother, VTI. This one's actually more popular. So the Vanguard Total Stock Market ETF has an objective which aims to track the performance of the CRSP US Total Stock Market Index. And that represents the entire US stock market, including large, mid, small cap stocks. Now the expense ratio is as low as it gets, 0.03%. Not going to get any cheaper than that. As for the AUM, or assets under management, we're looking at around $285 billion, and we have just less than 4,000 companies. When it comes to diversification, very similar to VT, it does not get any more diversified than this. You're going to have all different types of sectors, including tech, healthcare, financials, consumer staples, all over the board. The more diversified you are, typically that will help reduce your risk. Now, as I mentioned before, top holdings are going to be really similar. Once again, Apple, Microsoft, Amazon, Google, the big dogs, the mega tech companies. So in terms of risk, since you're diversified across all these different sectors and all these different types of companies, I'd say you're in the pretty safe territory when it comes to risk. So that's VT and VTI, the really large ETFs that hold pretty much everything. Let's get into the next option, which is a little bit more compressed. Now I'm talking about the Vanguard Information Technology ETF, VGT. So if you haven't noticed, the tech sector has been dominating the market. I mean, look at year-to-date 2023, it's ridiculous. The S&P 500 is doing well, the NASDAQ is crushing it. VGT offers a fantastic opportunity to ride the waves of innovation. So if you had this, you would have been holding Nvidia, you'd be doing pretty well. The ETF focuses on the big tech giants like Apple, Nvidia, Microsoft. So if you believe in the power of tech or the future of tech, VGT is going to be a good option for you. Now, the objective of VGT is to track the performance of the MSCI US Investable Market Information Technology 2550 Index, which is really long in a lot of words, but basically it represents the technology sector of the US stock market. The expense ratio is fair, but it is higher than the others at 0.1%. So this is nowhere near your income ETFs or anything like that because it's still a passively managed fund. So in general, it's actually a cost-effective option if you want to stay invested in the tech sector. Now, as of May 2023, VGT has approximately $46 billion in assets under management, and it is diversified within that tech sector, holding a mix of technology stocks, software, hardware, IT services, and semiconductors, which have been doing really well lately. So even though it is within that sector, the diversification does help reduce risk a little bit, and it also allows for that upward growth as the tech sector continues to grow in the future. AI. Now the top holdings are a similar story. Once again, we have Apple, Microsoft, Nvidia, but we also have some finance companies like Visa and MasterCard. So we have a mix of industries when it comes to the companies, and they're looking to showcase the innovative potential of the tech sector. When it comes to risk, this one's going to be a bit more risky than the previous two. The reason for that is we are narrowing down our sectors. But I always have to say, it's hard to have zero risk while still having great growth potential. So keep that in mind. If you have a higher risk tolerance, then this might be a good option for you as long as you're willing to hold long term. So overall, VGT can be an excellent option for investors that are looking to add tech stocks to their portfolio. With the holdings, the potential for significant returns as the tech sector continues to dominate and evolve over time, that should help drive your portfolio as well. Now, on to our next option, which is actually going to be VUG, or I like to call it VUG. This is the Vanguard Growth ETF. So this fund targets high growth companies with strong earnings potential, making it an excellent choice for investors seeking long-term growth and capital appreciation. With holdings in sectors like tech, healthcare, consumer services, VUG is all about capturing the growth potential for future market leaders. The investment objective is to track the performance of the CRSP US Large Cap Growth Index, which represents the large cap growth stocks within the US stock market. The expense ratio is very low at a nice 0.04%, which means it's giving you a super cheap option to diversify your portfolio. It's actually a pretty significant holding within my portfolio and also my baby daughter's portfolio. Now, as of May 2023, VUG has approximately $82 billion in assets under management. So it is a diversified mix of large cap growth stocks with its top holdings being Apple, Microsoft, Amazon, Google. You've heard it before. The reason is those are the industry leaders. They have the largest market cap, so you're going to hear those quite a bit. However, it is the rest of the holdings within the ETF to help it fit its objective. And those companies represent a mix of industries within the growth stocks category that showcase the innovative potential of large cap growth stocks. When it comes to risk, we are diversified. However, growth stocks tend to be a little bit more volatile than the rest of the market. So VUG is going to be more suitable to long-term investors that have a bit higher risk tolerance. Like I said, I actually have a significant holding in it, and my time frame is 30 plus years down the road. So I'm going to be holding for a while. All right, we have two ETFs left to talk about, one of them being significantly more volatile than the other one. And we're going to start with that one. So this is going to be the Vanguard Small Cap Growth ETF, or VBK, which I'm not going to call it that. But do not fear the small cap label, because these companies, yes, they are small in size. However, they have a ton of returns that they can offer. A lot of short-term traders focus on small cap stocks due to the volatility. So even though I consider this more of a long-term hold because there's potential for growth, keep that in mind. Essentially, if you're looking to add some high growth potential to your portfolio, VBK might just be what you're looking for. Now, the primary goal of VBK is to track the performance of the CRSP US Small Cap Growth Index, which represents small cap growth stocks in the US market. Its expense ratio is pretty fair at 0.07%, making it a cost-effective option for investors seeking exposure to small cap growth stocks. As of May 2023, the assets under management are around $13 billion, which is significantly less than the other ETFs that we have discussed. But it is still diversified across various sectors, including tech, real estate, healthcare, industrials. The list goes on and on. So obviously with diversification, having multiple sectors is going to help mitigate your risk in the long term. Some of the top holdings are finally a lot different than the others, and that is because they're going to be a lot smaller companies. So we could talk about DraftKings, Texas Roadhouse, Planet Fitness, which is my least favorite gym ever, and First Solar Inc., which has seen a massive run-up recently. So these companies represent a mix of industries and showcase the innovative potential of small cap growth stocks and could be the future. As I mentioned before, this is definitely going to be one that is for a more risk-tolerant investor. So you may see some ups and downs here, but if you're holding for the long term, I think this could be beneficial for you. So finally, to the number one ETF, my number one holding, although don't follow my advice, do your own research. We're going to talk about VOO, or VOO. This is going to be the Vanguard S&P 500 ETF. So this ETF tracks the performance of the S&P 500 index, which means it gives you exposure to 500 of the largest US companies. When it comes to a track record of solid performance and low risk, it does not get any better than the S&P 500 or VOO, or SPY. VU is a tried and true option for investors seeking steady long-term growth. And there's even a small dividend that comes with it. Luckily, the expense ratio with a passively managed fund like VU is extremely low, the lowest that it gets at 0.03%. VU is a very large ETF with just under $300 billion in assets under management. When it comes to diversification, well, you're going to get a mix of large cap stocks across various sectors, including tech, healthcare, financials, and consumer goods. Obviously, with diversification and large market caps, you are going to have mitigated risk when it comes to long-term growth. And no surprise here, top holdings are going to be Apple, Microsoft, Google, even Berkshire Hathaway. Overall, VU is a fantastic choice for investors that want a cheap ETF that offers broad diversification and holds only the tried and true top 500 companies in the US. Now, with that being said, those are our top 5 Vanguard ETFs that you have as an option to add to your portfolio if you're looking for long-term growth. Just remember, investing is all about finding balance between your own personal financial goals and also mitigating that risk. So at the end of the day, it's up to you guys to do your own research. So whether you want to hold only one ETF like VTI or VT and just cover everything, some people do that, or you want to hold a mixture of all 5 of these with various weightings, that's going to be up to you and whatever you think is best for you and your family. So I want to know from you guys. Leave me a comment down below if you have any questions about the ETFs we covered, or if you have your own personal opinions. I do my best to respond to all comments on all of my videos. And with that being said, I hope you guys have a great day, and I will see you next week. Take care.